Can capital gains push into higher tax brackets? The answer is absolutely yes. And it is one of the biggest mistakes that I see with people just overall in tax. So as we get into our conversation, I want to talk about the impact of capital gains overall and what is that for you, which I'm going to include in a trifecta, I call it, of what's going to cause your tax bill to go up. The next thing I want to talk about are the strategies to maximize and minimize. And again, that's part of that trifecta of how you make money, how you invest money, and what you can deduct. It's a whole system, and it is not difficult. It's just very different and nothing for you to worry about because you're not the expert in tax, which is why you're going to use me and my team. So to that point, if you ever want to talk to somebody one-on-one on our team, grab a strategy session in our link below. It's in the description. Call our office if you need help with this. And the last, I'm going to talk about the common mistakes that we see most people make when they're looking at this whole trifecta of tax. So first of all, just understanding capital gains. So capital gains is, by definition, let's just read it out and we're going to talk about it. And I'll explain the trifecta so I can put the rest of our conversation in context. So long-term capital gains are taxed separately from ordinary income and cannot push you into a higher tax bracket. Short-term capital gains are taxed as ordinary income and will push you into that tax bracket. So for example, if you're in the stock market only, which is one of the biggest mistakes I see folks that are higher net worth that have really busy either jobs or businesses, is you push most things off. You park and pray. You park your money with some sort of an accountant. You may or may not meet with them, except for you get your tax return and you just pay whatever you have to. So there's no strategy in your tax. That's actually the number one problem I see. Number two, then, is how you invest. So if you're only in the stock market because you're parking and praying out of convenience because you're busy life making the money, then you have long-term capital gains in a stock portfolio. When you start pulling or selling, you're going to start seeing some levels of capital gains. Short-term capital gains is very different. It's going to contribute immediately to putting you in another tax bracket. So our rule of thumb is to keep you below 42 to 48,000 in salary a year. Anything up and above that is going to cause you to be in a higher bracket and it's going to push you up. Now, if you are willing to drop even lower on personal spending, but have all your spending go to your business, which is corporate life, then you're a very different structure because it's a very different tax. See, what you want to pay attention to for you and your family is what flows through to you. So when you think about paying the IRS or paying yourself and paying your family, it is the trifecta. And I made all this up. It's living corporate life. You have to live corporate structures. You can activate 81,000 pages of tax code. It's taking all those deductions appropriately by the company and then you paying less personally in your expenses. And then number three, which is what I see the biggest mistake in generational wealth and tax, is how you invest. And most people just do the stock market or even Forex or even some cryptos. Those are all like capital gain sort of issues where gas and oil, real estate, mineral rights, water rights, aviation. There's a whole body of asset classes that actually can be depreciating assets against your highest income. And gas and oil is the highest one. You can write off about 85% of your highest level income, your most ordinary income, if you invest in gas and oil. So I tell a lot of our high net worth people, and we're filming this, say, the summer of 2024, you better stockpiling some cash because if you're going to need to buy depreciating investments, not stock market investments, to offset those capital gains, you've got to invest. So again, it's how you make the money, how you do the deductions, and how you invest. It's a trifecta, and most people don't see that strategy. And again, if you're treating tax like a once-a-year experience, it's why you're overpaying. And if you just save $10,000 a month, get this number, $10,000 a month in saved taxes over a 20-year period, invested at around 13%, well, just that one move, right, will make you a millionaire. You'll have put away $1 million into your own investment account versus pay the IRS where you didn't have to legally. But most of you are just running and gunning, doing your daily inherited behaviors or whatever you made up you need to do. You don't stop and hit a big reset. So we're inviting you to call our office, hit a reset button, and don't continue that behavior. You don't have to. A few other strategies to minimize, maximize your capital gains are 1031 exchanges. So again, anytime you're going to sell real estate, 1031 it to the next project. And it doesn't have to be single family to single family. I've seen a lot of people do commercial to a variety of single families, a variety of single families to one commercial. It's of like kind, but it also depends on your 1031 specialists. There's a few firms that our teams really, really like that we use that get it done efficiently and actually look at the whole structure, integrated plan, versus just a one-time 1031 transaction. Watch your trades, watch your capital gains inside your stock portfolio. If you're not watching it again, grab the link below. It's called iFlip. We use that all the time. That's how we invest in and out of the market. So you avoid those. I mean, last year I made about 20% on average in my iFlip portfolio, and that wasn't taxed. The tax on that was very, very minimal because of the structure. Last one, I want to just give you one other area is opportunity zones, which is real estate, where you can carry forward for generational capital gains. I mean, you could push that out for literally generations, 2-3 generations done strategically, if that's part of your plan. That's not part of a plan. Opportunity zones is something that's come in the more recent history. And I already set a long-term plan a while ago. And so to adjust that now, it's just currently not the plan. You never know if I'd add it. So I think a lot of you need to get a plan. And again, what do we mean by corporate life? I'm going to give you 2 tickets to our Millionaire Intensive. Go grab them in the link below and make sure that you actually come and learn, what do we mean by corporate life? How do you make money in a way that you can activate the greatest tax code in the world and then start investing for a better capital gain structure and keeping that tax bracket low? Those are our overall strategies for you. You all can do it. It's just different. It's not difficult, but you're not the expert. So whatever you're an expert in, I don't claim to be an expert in your category. Don't be one in a tax strategist. So we have an amazing team that will help and guide you, and look forward to having that conversation. Before I go on to the final mistakes and misconceptions about this, I want you to subscribe to our channel. Learn more about this conversation. So many of you come from a very old model of finance. You've heard from Dave Ramsey, Susie Orman, in a very, it's like, I'm going to call it safe, secure model of keeping a job and staying small. This isn't about staying small. This is like go big or go home. And we want you to activate the greatest laws that you can do to have the best structure for yourself. So the misconceptions are that a lot of these strategies are illegal or they're only for the wealthy. That's not true. If you're only worth 100,000 or 200,000, you need a trust. You need to not go to probate. You need to activate these strategies so you keep more of that money home and into your generational wealth plan. And if you don't want a generational wealth plan, you want to spend it through this lifetime, then do that too. But why pay another body, the IRS, or even the CRA in Canada, right? The Canadian Revenue Agency. Why pay them when you can legally take these home? So the misconception is huge. You say, yeah, but I've talked to my CPA. I know they're not a tax strategist. So they're just checking the boxes and filing those quick returns. Very different and huge misconceptions about what you can do. We're here 5 days a week. Go to my search bar, go to any playlist and really go through the tax, go through the credit cards, go through debt, and really understand the depth of the conversation. You are here to now start living. So if you have any questions, any requests at any time, go to askloral.com, ask a question, make a request. We will be right back with the answer within 24 hours.